Hey there, welcome to About That. I'm Andrew Chang. So tomorrow is a big day, Budget Day, the day when the federal government lets us all know how it plans on spending our money.
On March 28th, we'll be presenting the federal budget in the House of Commons.
Okay, so if you're a political or an economics junkie, then this is really exciting. If you're like me, you realize it's important, but it's still hard to digest. So let's talk about the thing that affects all of our day-to-day lives, which is affordability. And wrapped into that is everything from inflation to the housing crisis, high interest rates, the cost of living, you get it. So how the government spends money over the next few years really matters, especially when your budget and my budget are so tight. So today we're going to unpack where we're at financially and try to sort out where we could be going. So one of the biggest stories of the year has, of course, been inflation.
Prices are still going up. You're not going crazy. Everything is more expensive.
Airfares are 25% higher than a year ago. Hotels cost 50% more. Meanwhile, vehicle prices climbed 8% amid global supply chain problems.
Food prices are unbelievably expensive right now.
I gotta tell you, you stop and think before you put it in the basket now.
It peaked in the summer at a rate of 8.1%. That was back in June of 2022. And a year's worth of interest rate hikes later, sure enough, we are seeing a slow chipping away at that inflation rate. And I'll connect the dots here for you. So 8.1% in June, down to 7.6 in July, down to 7.0 the following month in August. It was 6.9 in September, 6.9 in October, 6.8 in November, then down to 6.3 in December, 5.9 in January, and then finally 5.2% in February. So, it's going in the right direction, right? This number was just out just late last week. But remember that the Bank of Canada target for inflation is 2%. So, and we don't even really know if that number is achievable anymore. Not everyone thinks it is, but I digress. Bottom line, inflation is going in the right direction. We just ain't there yet.
Our government will deliver additional targeted inflation relief. We can't fully compensate every single Canadian for all of the effects of inflation. To do so would only make inflation worse and force rates higher.
And who's got the stomach for higher rates, right? Because even though the inflation rate is steadily going down, food inflation has stayed at sky-high levels. Last I checked, grocery prices in this country were still hovering around 10.6% higher than it used to be a year ago last month, which is kind of wild. So how do we go about deciphering what's really going on here? Like some things are up, some things are down. What do we know about where people are spending their money? And how should that make us feel about this country's economic outlook? Well, there are a few key indicators that we can use, some of them more unconventional than others. Now, Stephanie Hughes is a reporter with the Financial Post. You're going to help us make sense of all of this. And let's start with that first. People are going to laugh at this first indicator, but lay it on me.
Okay, silly indicator, but $145 million US. That's how much toy sales at Spin Master fell year over year in the fourth quarter.
Spin Master, they make
Paw Patrol. Exactly, yeah.
I know this because I have two young children, yeah.
Yeah, exactly. Anybody with kids at home, you look in your kid's bedroom, there's Paw Patrol Hatchimals, there's a lot of toys that you spent God knows how much on just over the years.
Right.
But
so they've lost a lot of money.
Yeah, they lost quite a bit of money. And what this says to us is that parents are thinking twice about spending on non-essential goods, Spin Master being kind of a pure play discretionary good in Canada.
Right.
That could be for a number of reasons. It could be because prices are just climbing across the board. Inflation's up. Interest rates are up, so they're kind of getting hit with that double whammy of higher prices and higher debt costs. But then they're also wary that economists are talking about a recession around the corner, so they're probably saving a bit more. So what this tells us is that less discretionary spending could spill out to less spending across the board, could bring price pressures down.
Right, and that's kind of the important bit that I suspect everyone's waiting to hear, right? Because yes, if I understand you correctly, if people are spending less, especially on those discretionary goods, but if that is sort of just one factor among many where people are spending less and less money, hopefully that does ultimately bring prices down.
Exactly.
Like we're not too far off from that happening.
For sure, yeah. And of course, toy sales, that's one niche kind of drop in the bucket, but it's a fun way to illustrate just where Canadians' spending habits are at right now.
Okay, so indicator number 2.
Indicator number 2 is $1,156 US. That's how much market prices for lumber fell since the peak of the pandemic pricing in May 2021.
They were super high.
Super high. They were above $1,600 at a point US. Now it's more around $450 US, and obviously it's very volatile. But what this tells us, and this is going to sound very silly, but I get really excited about lumber.
Say that again.
I get really excited about lumber. It's an exciting space. Okay, so
I don't think I've ever heard that sentence uttered by a human being.
I'm a dork.
That's great. That's great.
But it tells us a lot. So it tells us where Canadian spending habits are. Are they renovating? Well, they were definitely renovating when everybody was locked down at home, and they had nothing better to do than to make a beautiful backyard oasis, maybe build a gazebo or improve the living room. Now, with inflation being where it's at, with debt costs being where it's at, people are kind of postponing their home improvement plans. People, would-be home buyers, are kind of on the sidelines, so there's less demand for housing overall. And
it's also tied to like manufacturing.
It is.
Right?
It is. It's tied to manufacturing, so it shows it's one input that's tied to manufacturing. So less manufacturing sales, and as far as lumber goes, ties into the overall gross domestic product, the measure that tells us how much our economy is growing or shrinking. So kind of has a knock-on effect. It's one example of a knock-on effect.
Yeah, one of many, and sort of one indicator of that being that, okay, so if lumber prices are down so precipitously over the last year, you know, that has, as you say, a knock-on effect with the manufacturing sector, cooling economy. Like this is what the Bank of Canada has been looking for, right? Like in terms of raising their overnight rate time and time again. This was always the goal.
It was part of the plan. Yeah, it was this really aggressive pace of rate hikes that we saw last year that brought interest rates to like 0.25%. Remember that? All the way to 4.5% in recent months. This is showing that those rate increases are having their intended effect with the economy and taking out that demand, whether that demand is in toy sales or in lumber or housing. And it's giving supply or people who provide goods and services a chance to catch up.
So I'm trying to keep track here. So Paw Patrol tells me that inflation may be cooling slightly, one of many indicators. Lumber tells me that interest rates may be settling at some point.
Having their intended effect, yeah.
What's the third indicator?
The third indicator is 22,000 jobs being added in February, and the jobs numbers are something of a wild card or this strange bright spot because it's an example of the economy being in excess demand, and it gets
heating up. Right?
It's heating up, or it's hot on the labor front, and it just goes to show how much we're still demanding services. And I'll also point to the January number of 150,000 jobs being added to the economy, and the December number of over 69,000 being added to the economy.
It sort of exceeded expectations.
These are estimate-busting numbers, and the reason for that is, if you go back to the lockdown coming off, the economic reopening, as it were, people like you and I, we want to go to restaurants, we want to get our hair done, and
live our lives.
Exactly, as normal as we can, and just go back to normal life. So employers are suddenly just daunted by this amount of consumer demand that came back to the economy there, and so they needed to hire people. They needed to hire wait staff, cooks, hairdressers, people who do nails. And so this really had this pushing up effect on how many positions were suddenly being created because there was a demand for it.
And I'm also thinking about all of those people who suddenly have more money to spend because they're employed, they're making more money, they have more to spend, which seems like it would have the opposite effect of what we've been talking about, right? That it could potentially drive prices up.
It's inflationary. So it drives prices up with people with more money to spend. And even simpler than that, employers, if they have to pay more on labor costs because it's a job seekers market right now, That's basically being passed through goods and services, which also has an inflationary effect.
So where does this leave us then? Because if I'm keeping score, it's sort of 2 points for, okay, things are cooling down, maybe there's light at the end of the tunnel, but these job numbers kind of fly in the face of that. So what does that all mean?
It means it's a very mixed economic portrait that we've got here. It's a frustrating answer, but that's what we've got right now. Some things are breaking the right way, others are not. The good news is that inflation is heading in the right direction, and the Bank of Canada hopes that by 2024, it will be back down to target, so that might give room for a cut. But right now, that's pause, wait and see mode. Economists are largely expecting one more bump up.
Interesting and crystal clear. Stephanie Hughes, thank you so much.